Okay? I'm going to wait and try to, let me actually remember to talk about that a little bit more when we get a bigger class, because I do want to make sure that that gets talked about and gets active discussion. I think it's going to be interesting, but it's going to require a certain level of participation quickly. Second question is anything with respect to last lecture's material. Last lecture we started talking about portfolio theory, which is a a very interesting and important idea. The idea that somehow that if you know some of the properties of securities, okay, namely what their expected return is, what their risk level is, how pairs of them correlate in terms of their risk, okay? Are they independent? Do they have the same risks? Are they anti-correlated? Okay? Based on that, there's an idea that you can somehow build an optimal portfolio. And this was kind of the interesting thing. That we sort of showed that by holding combinations, in the case of two stocks, where here we had two stocks, which had different returns, expected returns, and different levels of risk. The one that had a higher return rate also had more risk. Based on that, by modulating how much of each company's share you had, you could have build a portfolio with different properties. Certainly if you hold all of Merck, you get the performance of Merck. Certainly if you hold all of IBM, you get the performance of IBM. If you linearly interpolate with that, the expected performance is going to be, interpolate linearly with that. But there is also a well-defined risk in the portfolio. Okay? And the interesting thing is that there exists a point where you can own a combination of the stocks and it will pay more, the expected pay rate will be higher than owning one of them. And the the risk is also going to be lower. Okay? Because somehow that the odds of both of them doing badly, okay, is less likely because they're independent, okay, to some degree. Okay? Any questions about that? And we also saw that if we are allowed to short stocks, okay, if we short the slower growing one and use that money to put on the faster growing one, okay, if everything works out according to expectation, we will clearly be ahead of the game. If I can borrow money from you at 1% interest and put it in a bank paying 2% interest, I am ahead of the game. I get a higher return by doing that. Now the trouble, of course, is that these are expectations, okay? And because there's as we borrow money, in some short one, there is a chance the one that we shorted will actually outperform the one that we bought. And if so, that exposes us to loss. It increases our risk levels. But basically, with this kind of game, we can jack up the expected return higher at higher levels of risk. And the upshot of this was that given a pair of stocks, we could build a what we call the portfolio frontier of what are the optimal things to own, the optimal portfolios to own. This is the risk space, as measured by the standard deviation of returns. This is the reward space, as measured by the percentage, the returns. Okay? And I think it was returns per month in the particular graph that we were looking at. Here was Merck, there was IBM. We saw that as we buy more IBM in our portfolio, the returns would increase. The trade-off in risk did not become a linear thing. That was a nonlinear function. This is actually a parabola, it turns out. But there was a point here where there was less risk, okay, while a higher return than Merck. That was good. If we want by a higher fraction of IBM, the risk increases, but the returns increase. If we short it, our returns continue to increase beyond that. Okay? And that's what we saw here. If, on the other hand, we short IBM to buy Merck, okay, we're shorting the higher expected growth stock. To buy the lower one, our expected returns are going to keep going down, okay, because we are sort of expecting that we're going to somehow have to pay extra for the high growth stock that we shorted, and our risk goes up. So this is certainly not anywhere on the curve you want to be, unless you're managing money for someone you don't like. Okay? Any questions about that? Yeah.
So you're doing a two-stock model.
This is a two-stock model.
If you have a multiple stock model, are you going to get piecewise quadratic?
So what is it that we get if we get a larger number of assets? Okay? So my belief is it is still a parabola, okay? Although that's sort of based, I don't know if I have a proof for this right now.
I can believe that it's piecewise quadratic.
Okay, and maybe I can believe that too.
Right.
Okay?
Parabola.
Let's say I don't know for sure that it, let's say presumably it is a more complicated function. Okay, I think I believe that. Okay, it may be piecewise quadratic. It may be somewhat of a higher order curve. Bottom line is, here's an example of it, of the portfolios for a larger collection of stocks. Okay, and this is maybe now more interesting to look at. Here was we had like 6 stocks in the mix. This was what our frontier was when we could only own Intel and Merck. Okay, as you let me buy more and more stocks, okay, in my portfolio, my frontier of what I can achieve can only improve. Okay? If there was a company, Digiscam, that comes out that has negative returns and terrible volatility, it doesn't hurt us that it exists because we don't have to buy it. Okay? Or we don't have to buy very much of it. In principle, the more securities that are out there, okay, we can only improve our optimal investment frontier. And here is an example where in a world of these 6 stocks, each of which sat someplace different on the risk-return market, now the profile is out here. It shifted both out in the direction of being for any given let's say desired return, there was a lower risk portfolio involving a mix of these things. That was good. And for any desired risk level, there was a higher return portfolio that had that. Okay? That's what's kind of interesting about it. Okay? And again, the shape is, again, whether it's quadratic or piecewise quadratic, it is the result of solving some kind of a mathematical program, okay, to figure out what the optimal frontier here is. Okay? Note that when we have more stocks, there is no reason why the frontier has to lie on any of the stocks. We only had 2 stocks. 2 of the points on the frontier were all owning all of one stock or owning all of the other stock. What this frontier shows is that it is not optimal to hold all of one stock, any one of these stocks. Okay? It is more optimal holding a combination of them. Okay? And the ultimate combination of them is a function of, again, what is their risk, what is their return, what is their pairwise correlation with other stocks. So here, if we look at this company, which company is that? It looks like, I can't, anybody, it's funny, I can't, not GE, IBM, Mark. Let's say that here we have a stock with the property that it's a high-risk stock, higher risk than GE, and lower return. Okay, what company was it? IBM. Okay, this was what used to be that's what used to look good to us, right? Now it looks like a bad company compared to GE. Is it possible that IBM is still useful to us in building portfolios? And the answer should be yes. Okay? For example, suppose, let's say that IBM had an its returns were inversely correlated with GE. It looks like IBM and GE are both show roughly similar returns, right? If this stock was inversely correlated with this one, buying the mix of them would give us this return at no risk, right? So basically, the question of whether something is valuable or not, or useful, is going to depend not only upon its returns, and not only upon its risk, but how well it is correlated. Its returns are correlated with other stocks. Any questions about that? Okay? And so in this investment frontier, we live in a world where any point from here to here seem like potentially valuable investment strategies, right? Because here, once you decide what your level of risk that you're willing to live at, okay, this is then the optimal point to be on, okay? Any questions here? It is not obvious which of these points is better than which of those. All of those are perfectly valid strategies, okay? They dominate any other portfolio that's to the right of it. But there's ultimately a utility question of which of those is better. Any questions about that? Okay, this is kind of an interesting theory. Okay, it shows us a way that we can use diversification to come up with a better portfolio for doing what we want. Yeah.
Side question. What's known about calculating these
So to be okay. So it is clear that these things. Okay, let me think about this. So that this, you're not really asking an algorithmic question here. Okay. And to be honest with you, I am not sure. Okay, now these things get expressed as what I believe is a quadratic program, which would argue that it is not efficient to compute for large collections.
What you need to do is you need to take the maximum recognition, because you can actually you look at stocks, and some stocks obviously are not going to the next.
Well, it's hard. Actually, the answer is no. You can't say that based on.
The stock has better return and lower volatility than another stock, and the stock that had.
Well, no, I still claim it. Then it becomes a question of whether its returns are correlated or not correlated. Okay. So that by itself is not enough. The correlation is important because that's where the importance of diversification comes in.
Okay, so where does the correlation? Oh, I see. No, so where does the correlation?
So if we go back to the expression here, it said that the variance is a function. You need the covariance there.
So you need the covariance matrix and calculate.
Yes. Okay. Any questions about that? So the interesting thing here is, and I think this is kind of interesting, is that we can now design portfolios that will do interesting things for us. Okay? Any questions? Now, the examples we showed before, okay, with this portfolio frontier, all assume that we were investing in stocks. Now, one other thing that we can invest in are assets at a risk-free rate. Okay? Does everybody agree with that? That we live in a world where we can always put money in the bank, and there is a certain fixed risk-free rate for it. So what does that mean? That if we add that to the mix, portfolios end up looking a little different. Optimal portfolios look different and arguably simpler than before. What is something at the risk-free rate? It will pay a certain amount per month, and there is no risk. Does everybody agree with that? Here we have a bunch of portfolios with the property that they have some risk, okay, and some return to it. Now, let's think what happens if we take the tangent line to this surface that just kisses this parabola-like thing, or quadratic-like thing, okay? If this thing is convex, which I believe it is, which it will be, okay, there is going to be one tangent point where a line rotating from the risk-free rate is going to bunk into it. Does that make sense? Okay, if you have a point that is fixed, something can rotate on it. If it's hitting a convex object, there will be a point that will be tangent to it. And this is the tangent line, and it is touching one point on the portfolio frontier. That means a particular portfolio. What's interesting about this line, though? Now, suppose we want to take a portfolio which is some fraction in cash versus some fraction in that tangent portfolio. If we put all of our money in the cash, we would get this much risk and return. If we put all the money into the tangent portfolio, we would get this risk and return. Is that clear? Now, what happens if we linearly interpolate, if we put some fraction in each? This line over here gives us the risk-return profile for a portfolio that is some fraction in cash and some fraction in this tangent market portfolio. Okay? And so what's interesting about that? If this is the performance of that portfolio, because this is convex, what's interesting is this tangent portfolio, governed by this line, this mixture of risk-free and that tangent portfolio, dominates the performance of all the other portfolios. Because look what we're doing here. It should be clear that if we get this return from the risk-free rate and this return from the tangent portfolio, if we put half of our money at the risk-free rate and half of the money in the tangent portfolio, our return is going to be midway through that. Right? And the risky part has risk. The part that's in the risk-free rate has no risk. Okay? And it's not correlated at all to the risk in the, it's uncorrelated with the tangent portfolio because it's a risk-free thing. There's no correlation, whatever the tangent portfolio does. Okay? So what's interesting here is, if we interpolate a certain fraction in cash and a certain fraction in the tangent portfolio, we end up getting any level of return along this, okay, with this level of risk. And if you look at it, for every point, this line is dominating, okay, the portfolio horizon that we had before. Does that make sense? It's kind of an interesting thing that this tells us that the optimal way for us to spend our money is to put some of it in, no matter, depending on what your level of risk or return concerns are, is to put some of it in at the risk-free rate and some of it in the rest of it in the tangent portfolio. And the mix between these two things is really the optimal thing to be doing. Okay? That is really somehow then what the optimal, if you live in a world of risk-free assets, that then becomes the optimal strategy. Okay? Any questions about that? Okay? It says that there is somehow, once we know this, that, we have to construct to define what the tangent point is. This tangent portfolio, okay, presumably involves, if we think about it for the whole market, it's going to involve combinations of all the stocks, okay? And in fact, I think under certain models, it basically works out to holding all the stocks with the same capitalization that everybody else does. In fact, one way to think about it is this, okay? If this is the optimal portfolio, note that if this is the optimal portfolio and all it depended upon was the risk-free rate and this point, the mix of stocks that you should hold is the same for everybody. That's one interesting consequence of this. Okay? If we lived in the world before where this was a perfectly valid strategy and so was that, the difference between here and here were that the two portfolios would have different mixes of stocks, different percentage of stocks, that they of certain securities that they would have over others. But if this is now the world that we live in, if the risk-free rate is the same for everybody, then what's interesting is the mix of stocks that everybody should have is exactly the same. If you're saying, oh, I want to be safe, well, you might want to say, I want very little in this mix. If you tell me I want to live out on the, put everything I have into the market, you should own this. If you want to do even better than that, but at greater risk, you should probably borrow money and invest it in this portfolio. And that's basically what the tangent line is sort of showing. Okay? But what's interesting about this is it then argues that everybody should own the same set of stocks in the same proportions. Okay? And the only issue is who how much, what fraction of your wealth do you have in that? That's what the interesting thing about this argument is. Any questions? Okay? And what's more is this basically tends to work out then if everybody should be holding this. Either that actual point or a good approximation of that actual point is what is it that everybody in the world is holding. Which means that you should hold a portfolio that is basically proportional to the weights of the market capitalization of every company that there is. Because if you think about it, how much GE is owned out there? It's a function of the price of GE times how many shares of GE there are. Okay? And what this theory basically says is that the optimal thing to do essentially is going to be to take the market portfolio, okay, and then hold some fraction of it, or not, okay, depending upon what your desired level of risk is. Any questions about that? This to me is actually interesting, yes. Well, the reason is, let's say geometrically, if you believe this is the tangent line, I think this will be clear. Why is it? Let's compare it to, if let's say I am willing to suffer this level of return, I want this level of return, I can either do this or this, right? This was my optimal investment horizon, which was worked out by solving this complicated mathematical program before, okay? Either I could own a point on here, paying that, or I could own the linear combination. Look at the difference. This point is to the left of that point, right? Well, the tangent. First of all, a line is defined by 2 points, right? We will say that there is clearly an optimal thing. What is the best you can do if you're willing to suffer no risk? What is the best portfolio to own? I think that's pretty clearly the risk-free rate, right? So clearly if you're saying, I won't have any risk, this is the best thing to do. So we know that on the optimal horizon, this is a possibility. We know that any point on this tangent line is a possibility, right? Because we can realize it by a fraction of stuff at the risk-free rate and a fraction of stuff in that portfolio. So we know we could do this. Or we could ignore the risk-free rates, holding anything at the risk-free rate, and instead do it at the tangent. But the key point is that if we now draw a line through this, by definition, this tangent line, because it's swept in from the outside, is going to be to the left of every point on the, on the old parabola-like thing. Okay? And if that's so, then by definition, it's going to have to offer a lower risk for the same level of return. That's what it means to be to the left of it. And that's why the tangent line turns out to be the interesting thing. Does that make sense now?
Okay, so essentially what you're doing implicitly is the fact that there's volatility. In order to say that the tangent line does give you the function that you want, and essentially you're implicitly using the fact that the risk-free asset has zero volatility.
I'm using the fact that the risk-free asset has zero volatility.
And otherwise you get a parabola, but that's why you get it.
I think it's because it has zero volatility. It also has zero correlation with anything else.
That's why the tangent line has that.
Yes. That's why the tangent line happens to. We agree that as we own a different fraction of it, the return obviously scales linearly between this and this. The thing that is less obvious is, does the risk scale linearly between this and this? But in order to do that, we then got to go back to the equation of where this thing came from. Okay? And we know that the volatility here is 0, and the covariance here is 0. Okay? So basically the volatility that you get is going to just be this. Okay? Which is a fraction of what you're actually holding. Any questions? So this is interesting now. It tells us that basically the right way to invest is some fraction in cash and some fraction in the optimal portfolio. Okay, and perhaps we can work out the optimal portfolio by doing these calculations. If we have our sense of what returns are and risks are and covariances are for every stock. Okay, we can work out this frontier. If we believe other people, then that point should be basically what everybody else in the world is owning. Okay? And then we maybe don't even have to solve our equation. Okay? Although perhaps it's reasonable that we would have different estimates for future returns or things like that than other people. Any questions? So this to me is actually kind of an interesting thing. Okay? Any questions now about it? Yeah, sure, good.
You mentioned that if you want the positive plus the tangent point,
Yeah.
if you want to maximize your return, if you borrow money from them.
Yes.
This is shown from the line, right? I cannot get it.
Well, what is this thing doing? Let's say if I'm trying to figure it out. The claim is, okay, if I'm on a roll here, how did we get, remember before, okay, let's look at this thing. Before when we looked at this, we saw that this was owning some of Merck, some of IBM. This was the result of shorting the slower growth, this part of the curve out here. We got higher returns. Even than the highest grossing stock, the highest returns on at expectation. Even than the highest security that was out there. And how did we do that? In this case, we shorted the slower growing one, which was essentially expected to pay 1%, and used that money to buy something that was expected to pay 1.5%. Okay? And the good news was, on expectation, our returns are going to be bigger, but we were exposing ourselves to more risk, right? Now, a similar phenomena, actually, wait, which way do I go? This way. A similar phenomena is happening here. One way I can go beyond this point of the optimal portfolio is to borrow money. I can borrow money at the risk-free rate. The risk-free rate is expected to be less than the optimal portfolio, right? So I can juice my returns by paying more, by borrowing money and going beyond this. Of course, my risk increases. It increases in some sense more slowly, perhaps, than when I was shorting the stock, because there two things could move. Here, one of them is fixed, okay? But it could be that I decide to borrow a lot of money to buy stocks at the beginning of this semester, okay? And then stocks went down a lot, right? So there is a risk for this. Okay? But what's interesting is this frontier gives us, in some sense, the optimal way. Once you decide well, how much returns you need, what is the lowest risk way of doing it? That's the interesting thing.
So the reason why this doesn't work in practice is because the return you get for investing in a risk-free asset is going to be less than what you can borrow with, what you can borrow for. And so therefore that line over there, after you hit the tangent point, is going to keep down a little bit.
Well, first of all, let me say I don't believe that what you're saying. First of all, the answer is it pays to do it if someone will loan you the money
At the risk-free rate.
At the risk-free rate.
What I'm saying is in practice, you can't borrow money at the risk-free rate. You can borrow, I think about it in practice, you can't borrow money at the risk-free rate. It's going to cost you a little bit more to borrow money.
Well, maybe if let's say if it costs you more to borrow the money, then it would pay to bend this down.
Right.
Okay. Now, on the other hand, a lot of the hedge funds that did very, very well over all these years were doing what? They were borrowing money, essentially, so they could run at higher leverages because they think they had designed portfolios with small enough risks that this was contained. Okay? So these guys were, in some sense, what is leverage? It is borrowing money so you can buy stocks so you can get more of an effect of it. That is really what this is saying. Okay? Any questions about that? That's an the question of exactly what the rate at which you borrow money for is that I agree will wiggle the curve. Okay? Okay. But ultimately I think is so long as you can borrow money at the lower than the expected rate of return of the portfolio, in principle, you can juice your expected returns at some risk. And you have to decide whether or not it pays to do it. Okay? And, ultimately, there's a story of this guy who would, one way to, let's say, one gambling strategy I once heard of, they called the O'Hare straddle. O'Hare is an airport in Chicago. And what would you do? You would go and borrow money from the mafia. Okay? And you would go take this $1 million you borrowed from the mafia and you'd put it in, go to the roulette wheel in Macau, let's say, and put it on black. And 50% of the time you would win. In which case you would take the $1 million that you had you would borrow from the mafia, you give it back to them. And then you live on the rest of the $1 million. But if it came up red, then you had set aside enough money for a plane ticket because you knew you had to get out of there because you had no way of paying them back what they had loaned you. Okay, that was the question of, I guess, something about returns versus risk. Okay? Any questions? I don't know if that made any sense or not. Okay? But that's basically all that we are saying. If they're willing to loan you the money and you're willing to take the risk, this is the thing to do. Okay? But of course, when you take risks, there are consequences. Okay? Any questions? Okay. So this is all, I think, a very nice and good theory. Okay, and this is what we would call the Markowitz portfolio theory. I think you won a Nobel Prize for this. So good thing. Okay? And it tells us how to manage portfolios. If we know the expected returns for each asset, the volatility of each asset, and the pairwise correlation between assets. Okay, and we can solve the resulting equations. Okay? Now what do we know? We have talked here about measuring volatilities. Okay, so we have some estimate of volatility, and that makes sense. Estimates of expected returns. This looks like a dicier question, right? Because somehow you have to look at a stock and make an estimate of what its returns are. Maybe you would, you may plot a slope of its current returns. That seems like a dicier thing to know. Pairwise correlations between N stocks. There's N choose 2 pairs of stocks. You could estimate what the correlation is by computing the correlation coefficient. But it should be clear that this is a model that has a lot of parameters. So the good news is it's a nice theory. The bad news, it requires a lot of parameters you have to estimate. And if you do a lousy job estimating the parameters, then you don't get good answers. Any questions? So there is another model called the capital assets pricing model, which is usually pronounced as CAPM, which is which is interesting because it simplifies everything. So that instead of thinking about correlations between pairs of stocks, it reduces everything to a linear number of parameters by measuring each stock's correlation to an index. Okay? This index is the market portfolio. What is the market portfolio? If we take every stock and we take its capitalization, there's a certain amount of money implicitly invested in that company, which is a measure of the number of shares times the share price. If we take the weighted average of all the stocks, or the weighted sum of those stocks, that's the entire market capitalization. If the market portfolio takes our meager amount of money that we have in our portfolio and invests it in each stock according to the weights of its market capitalization. This is like a weighted index. When you look at the S&P 500 index, that's a weighted index of all those S&P 500 stocks. The capital asset, the CAPM, what it will do is it will simplify this portfolio model by relating asset values to to the index, like the S&P 500 index. Okay, and thus we're going to get rid of the quadratic dependence on the number of pairwise correlations. That's what's going to be interesting. It is a simplification of the previous idea. Any questions?
So what does the index imply? It implies that it tells you the expected values of the volatilities or something.
So the index, remember what we had talked about risks. We said that there were two kinds of risk. The volatility in a stock is somehow related to two different kinds of risk. There was the systematic risk, which were the things that happened to everybody in the market. And by definition, when something bad happens to you because of something that happened to the market, it happened bad to the S&P 500 too. And there were specific risks. Risks that happened to your company, but wouldn't affect anybody else. Okay? Like your executive running off with the money. Like you coming out with a new product. Okay? Any questions about that? So what is the idea here? The idea here is that we are going to instead, we're going to compute basically one factor for each stock, okay? Namely, its beta. And by beta, what it means is it is the sensitivity of its movement to the market portfolio, okay? So here's the equation for it. It's the covariance. If you want to figure out what is the beta for some stock J, if you found the covariance between the returns of stock J and the market returns, and you divide that by the variance of the market returns, this gives us the beta. It's a little bit like a correlation. What was the correlation coefficient? First of all, what was covariance? Because I don't frankly think very well in terms of covariance. The covariance was given two time series. It was the expected value, it was the deviations in one relative to its mean, times the deviations of the other relative to its mean, the expected value of this. Okay, so we summed over all intermediate points. How much did the returns of one that day differ from its mean? Times how much did the other signal differ from its mean? Just like with correlation, if both went up, both had a positive confirmation, positive times positive was positive, negative times negative was positive, negative times positive was negative. So we lost points in the covariance when they did things differently relative to their means. But we gained points whenever they behaved in sync. So this is measuring how much are they in sync, and it is normalized by the variance of one of them. The correlation coefficient was normalized by the standard deviation of each of them, the product of the first times the product of the second. And somehow that magically worked out to running from -1 to 1. With beta, there is not quite the same normalization, but it has a couple of interpretations. One is that, that for a risk-free portfolio, the beta is 0. Why is that? The returns, if it's risk-free, it's always paying the same amount. So the today's returns minus the expected returns are 0 every day. Okay? So beta is 0 if, what do you call it? If it is, beta is 0 if it's a risk-free thing. If we feed it the market portfolio, the market portfolio has a beta of 1. Because basically it works to this over this. Okay? I think I have a square missing from here. Okay? That's the reason why. Okay? Okay? Because variance is squared. There's standard deviations and variance and stuff like that. Right? So the difference here, right, so this should be a square here. And then, if we have the beta equals 1, that means, for the market portfolio itself, we get beta equals 1. If we have a stock whose movements are greater than the corresponding movements of the market, it gets a beta greater than 1. If we have a stock that moves less than the market, we get a beta less than 1. Any questions about that? So suppose, we have an example here, no. But suppose we have a stock that every time, if the S&P 500 goes up by 1% that day, the stock will go up by 2%. That would mean it would have a beta of 2. Okay? So this is sort of the index at large. Certain stocks will be more reactive, more volatile. Okay? And if the S&P 500 has a good day, they're expected to have a very good day. And if the S&P 500 has a bad day, they're expected to have a very bad day. These would be high beta stocks. Certain stocks would be certain stocks would be less sensitive to the movement of the index. And those would be low beta stocks. Any questions? So what's interesting about this? We can now take any stock and compute its beta relative to the market and determine which are high beta stocks and which are low beta stocks. And why does that matter? Because if we want to predict the return of a stock, my claim is that the return of a stock is going to be decomposed, or at least Capham's claim is that the return of a stock can be decomposed into 3 units. One, the major one as far as we're concerned, is its sensitivity to market movements. Okay? If a stock is going to have a beta of 2, its returns will be twice that of the market returns. Okay? If the market returns go up, it's twice that. If it goes down, it's twice that. Right? So we're going to say that a company's return, a stock's return, is a function of some drift, some naturally escalating price value. Okay, that is a constant. Okay, it is a function of a dependence on a market. Okay, and the market returns, or whatever volatility there is with that. And there is a specific risk component, okay, whose mean is 0 and whose variance depends upon the particular stock. Okay? Some companies may have a higher specific risk. Again, if we view the specific risk as the manager sitting in the plane ready to run off with all the money, some companies may have, the manager may always have the plane turned on so they can get ready to run. Okay? Others wouldn't. This is going to be the specific risk of the company. The claim is that for every company, its returns are basically going to be some function of the market risk and some function of its specific risk. Okay? Any questions here? And this is interesting because this gives us a way to now model what the returns of a company, we can measure the beta. We can think about the market value, but this thing gives us a way to compute what is the expected returns for a particular stock, okay? Just as a function of its beta. Any questions about that? Okay? And we can compute these parameters of alpha and beta. We could compute beta, if you wish. If we just believed in beta, for a given stock, we could compute what its beta is using this formula. If we believe that a company's returns are given by this equation, we could take a look at its returns. You have one variable, which is this, and one variable, which is that. The random noise is an expectation of 0. That's somehow the prediction error. We could figure out by doing linear regression, given the returns of this company and given the market returns each day, what are the alpha and beta constants that best predict the returns here? And this then gives us a model for what are the returns of this company as a function of its beta, as a function of the market returns. Okay? Any questions? And more to the point, okay, the expected return on it is going to be, as I said, alpha plus beta times the expected market return. We can also work out what the deviation of this should be. It's a function of the market return, the market volatility, the dependence on the market, and it's a function of the specific risk. What is the expected value of the error term that we get here? Okay? Any questions? So the neat thing about it is that if we believe this kind of a theory, beta in some sense discovers everything. Okay? And all the issues of what is the performance of a stock and what is the dependence of one stock on another reduced to computing these betas. Any questions? So here would be an example of things, just to take a look at this thing. Here we have two stocks. We'll say that the market volatility is 20%. Here we have a stock one which maybe is in the steel business. Its beta is, let's say, 1.5%. 1.5. That means if the S&P 500 goes up by 1%, it will presumably go up by 1.5% that day. Certain market stocks are going to be very dependent upon the health of the other stocks. Steel is a good example. If car companies are doing well and everybody is doing well, then people will buy more objects, and that requires buying more steel. If, on the other hand, stocks are going down, people stop buying cars, they stop buying steel. Okay? Perhaps software has a less strong dependence on the movements of the general market, but it may have more other residual variance. So what does this mean? When we take a look at, we compute the alpha and beta, we can figure out what is the optimal beta for a stock. We can figure out how much of its variance is then explained by this beta. So if we say that the returns of stock J are basically going to be equal to beta times the market returns, there's also going to be an error term. We could figure out how much of the volatility is left unexplained by this. By what is the magnitude of this each day? That is what we mean by the residual variance. Okay? So here we have two stocks. Both of them have the same actual variance. This one has more of, because this one has a higher beta, more of its variance is explained by the movements of the markets. Because this has a higher residual variance, more of it is explained by specific risk. Okay? Any questions here? So this theory does not say that higher beta stocks are always more risky than others. The risk is a question of market risk and specific risk. The specific risk can be estimated by what is not explained by when we factor out the market risk. Okay? Any questions about that? That I think should be clear. And if we believe this thing, what turns out to be interesting is you can start to figure out questions about what the required rate of return is, okay, for a particular stock. What does this mean? If we have some stock here, I can always put my money in the risk-free rate, right? If I have a choice, you're selling your lousy stock, did you scam? I could either buy did you scam, or I can put my money in the bank. If I put my money in the bank, I earn the risk-free rate. Okay? If I have if there are I could also put it in the market index, and I would earn the return for the market. If your stock has a particular beta, okay, the returns we would say are going to be basically, if you have a particular beta, your returns are going to be that amplifying the market rate. Okay, by solving this equation, this gives me how much for if a stock has a particular beta. The argument is that that this governs how much that stock should return to make it worth having that level of exposure to market risk. If beta is 1, this works out to RM minus the risk-free rate plus the risk-free rate. We get the stock back, the market rate. If the beta of a stock is higher, it is riskier. It had better pay at least this level of return, or else I am better off owning some kind of another stock of equivalent beta. Any questions here? But what's interesting about it, if you believe this theory, the relative return of a given stock is completely determined by its volatility. Okay? That's really what this is sort of saying. How much its dependence is on the market. Okay? Any questions? So the good thing about this is that we now have a much more manageable theory to predict how one stock will impact its portfolio. We compute its beta, and now we know an estimate of its return. We have a lot of things that are interesting. So if we believe this CAPM theory, the capital assets pricing model, we now know that the price of a stock, okay, is going to be purely a function of its volatility. Okay? And that's a little bit different than some of the stuff we talked about with arbitrage theory. The prices of options are partially a function of volatility and partially of other things. But again, we can accept both of these theories. Does the CAPM model explain all the variation in stock returns? Apparently not. Okay? But what's interesting about it is relatively a much simpler model than the full Markowitz portfolio model. A simpler model has fewer parameters and is arguably more robust than. Okay? And that this is widely used, we give it our respects. Any questions about where this pricing model comes from or anything like that? Okay? It basically says that we compute the beta of the stock, we know how much of its risk is market dependent, how much of it is specific. Based on this, we can now optimize our portfolios. Okay? And this is a simpler thing than before. Any questions? Okay? Any questions about capital? Now, there are other predictors of returns that are interesting empirically. Okay, the theory I think is good, but in fact, when they do experiments, let's say empirical results, people have started to study what is the relationship between volatility and return. Is there more return on more volatile stocks? And people have found that that seems to be weakening in recent years, okay, for whatever reason. But there are other, let's say, factors that seem to correlate with returns, okay, in an interesting way. This here is showing a graph of what is the return of companies in, I think there's 10 bars, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. If we take all the stocks, companies, and we put them into 10 bins based on what their market capitalization is, the 10% of the companies that are smallest goes in this bin. The ones that are from 10th percentile to 20th percentile go in this bin. 20th to 30th percentile here. The 10 percentile largest companies go in this bin. What does this graph show? It shows what is the observed average return as a function of the size of the company. And there is some evidence that's been fairly consistent that in general higher stocks, smaller companies have higher average returns than larger companies. Why might this be? You would think of a reason why smaller companies might have a higher return than larger companies in the context of what we've been saying. You say they can expand more easily? Maybe. Okay, but we haven't really talked about that. I would say they have higher risk. That is sort of the argument that to me makes sense. You own, baby computing and company. Okay? It is, as it's small, there is a chance it's going to get big, but there is also a chance it will be stillborn. It'll die quickly. So in fact, what I believe this kind of figure shows is a return risk issue. Risk being measured by size rather than volatility. Our definition of volatility each day, how much up and down movement, is one measure of risk. But there are other measures of risk. So if the United States government has decided AIG is too big to fail, then there's in some sense no risk on it. Okay? Any questions? So that would be one argument here. Here's another one where another correlation between, where they relate companies to their accounting values. So one thing you could do is if you took a company would have a certain value if you dismembered the company and sold off all its parts. Right? If I had a company has a certain amount in the bank. It may have a certain amount of spare parts sitting around. Okay? It may own its factory. Companies have certain values. If we suddenly decided to break the company apart and sell it, the book value of a company is how much a company is worth if you break it apart. Okay? And by using accounting measures, you can figure out what a company is worth on its books. And the market-to-book ratio is a measure of what is its capitalization alive versus what would it be if we declared it dead and we just sold off all the parts. In principle, a company with a lower, which has a higher book value, is presumably less risky than one that has a lower book value. And this is basically showing things that, in fact, it's sort of inversely the case. The things with the, again, whether we talk about it as market to book, in this case, that the companies that have the better, more book value end up performing better than companies that have worse book values. So you have a company that owns nothing if they got sold, okay, into parts. They own nothing tangible. Okay? But they do have a capitalization if people think they're going to go ahead and do something. Those tend to show worse returns long term than companies with better book values. Okay? But anyway, again, it's different notions of risk that these things are measuring. Any questions? One other interesting measure. Okay, so we have this vision that in any portfolio, there is a trade-off between risk and return. And if you wanted to, let's say, rate mutual funds, or a portfolio manager, or something like that, you need a statistic that captures both how much returns they've been making and how much risk they have been exposed to. Does it make sense that if you want to say, look at me, invest in my mutual fund, I earn 10% a year, that captures one aspect of where they might sit on the portfolio curve. But it doesn't say anything about what the level of risk that they're exposing you to. So a statistic called the Sharpe Ratio, after a guy named Sharpe who came up with it, measures the performance of a portfolio by what has been its returns minus the risk-free rate returns, what has been its expectation or average of that, divided by the standard deviation, or equivalently the square root of the variance, of the difference between the performance of the on a daily basis of the portfolio and the risk-free rate. Okay? So this statistic, the more returns you learn, the better this is. The lower your variance, the better it is. Okay? If you have high returns but high variance, your ratio isn't good. Okay? If you have low returns but lower returns relative to somebody else with the same variance, your Sharpe ratio isn't going to be as good. Any questions? An interpretation of what this number means can be thought of in this idea that we were having about borrowing money to buy stocks. If, let's say, you were limited to, you had a bunch of different portfolios out there, and you're allowed to buy one of them and do one of these shorting strategies. In a shorting strategy, remember, we were borrowing money at the risk-free rate to buy a stock which had some return, or a portfolio which had some return and some risk. Something that has the best Sharpe ratio has the best performance of return relative to risk. And so the argument is that you're allowed to own one stock or portfolio, and you're going to do shorting in order to realize it. The right thing to do would be to pick the one with the best Sharpe ratio. Any questions? Any questions about what this measure is, or why it is an interesting thing? It should be clear that if you want to measure how good an investor is, it's not just their returns. It's their returns corrected for a level of risk. Because we have shown anybody how they can jack up the expected returns by simply borrowing and borrowing more money. Okay, if you fell for that, when times got bad, perhaps your investment went out of business because the variance was high. The risk level was high. Any questions? So this Sharpe ratio thing is actually a good idea and an interesting measure of value for a company or a mutual fund or something like this. Here what we have is our graphs of the Sharpe ratio, meaning the risk return, the return over the risk, over for a large number of funds. This shows what is the magnitude of the Sharpe ratio. It showed that Sharpe ratios in general for stocks ranged in over this period of time. There were some stocks that were were very, very bad. Their return over risk was nearly zero. There were other stocks that were very, very good. Of course, there's sort of a distribution in this range. Okay, and there were more here. This curve shows how did the stock rate, if we rank stocks by their percentile Sharpe ratio, and we compare that ranking to a well-known set of mutual fund evaluations, we get an almost linear correlation. Meaning that against what, if you want, how is it that a well-defined rating of which mutual funds are best or worst, it correlates largely to the Sharpe ratio. That's what this argument is. Any questions? So if you're an investor, the wrong thing to ask is, what is my return? The right thing is, what is my return for my level of risk? Any questions? So you can do all kinds of interesting things now to, let's say, model different investment strategies. Once you have an idea of what is the trade-off of risk and return. Here we have, we can rate funds based by how actively they trade. Certain kinds of investment strategies may involve having large numbers of trades. I'm going to buy and sell stocks every day to adjust to every other condition. Such stocks will have what we would call high turnover ratio. We could have somebody who buys stocks and never sells them. And that would have relatively low turnover. What's interesting is when you compare funds, what were their returns versus their turnover rate? Okay? The ones that in general show lower turnover, okay, less active trading strategies, seemingly perform better on a risk versus return level than strategies that involved a lot of trading. Okay? That's sort of what this chart would be figuring here. If you compare, let's say, the investment funds of a lot of, all the investment funds, you compute their Sharpe ratio, you measure how much they trade, which is a measure of how much dollars buying and selling did they do over the total value of the fund. Okay? Again, less trading, seemingly better management performance. Different trading strategies will charge different amounts of money than people who own a mutual fund. Some of that money is you invest the money in the fund. Most of that money, almost all of it, should go to buy stocks. Some of it is going to go to the managers who run the fund. And one might think that if you pay managers more money, they will be smarter and they will run their business better. Okay? This is a graph that would show, as a function of the expenses that the fund pays. These are the ones that are less expensive, that have a smaller percentage of the investment used in expenses. These are the ones which have a higher percentage in investment expenses. Again, a lot of investment expenses are related to trading. If you have a stock fund that's going to buy stocks and not do anything, you don't need to pay very much to managers to make those decisions. They're going to do nothing, right? You don't have to pay money to people to actually execute the trades. So this curve should correlate well to the turnover graph that we showed before. In general, less active strategies showed better investment performance, risk-return performance. Large funds versus small funds, which showed better investment performance. Here we show the Sharpe ratio as a function of the smallest 10% of funds, the ones from 10 to 20th percentile in size. These were the 10% largest funds. The larger funds here showed better investment performance. Why is that? Well, one reason might be if you have a fund that is performing well, smarter investors would invest in that fund. Okay? And so we would expect that the funds that, let's say, are performing well morally should be larger. If they are performing well, they're going to grow, even if no one else invests in it. Just if you put the same amount of money in all the funds, the ones that will be doing better are the ones that will grow faster. Okay? So this sort of shows that the other issue is apparently that the larger the fund is, the less expenses you should in principle pay. Okay? Relative to the amount of stuff that you're actually managing. It's not clear it's harder to manage $2 billion worth of money. Much harder than it is to do $1 billion worth of money. You still have to pay accountants to publish reports and things like that. So the expenses should be lower as the stock funds get larger. Any questions? So the moral here is that when we want to think about what return should be, what are reasonable models for it, we have to think on a risk-return model. And the portfolio management tools we have talked about give us a way to figure out or trade off between risk and return, okay, in a sensible way. Any questions about that? Okay. Any questions? One last, okay, so I'm going to stop here. One last question about would have to do with the homework 2. Have any people started thinking about, last class I passed out the first homework assignment, the second homework assignment, which is one where you are going to have to develop and assess trading strategies. I assume, is there anybody who actually got started on it? Okay, no one. I do strongly encourage people to get started on it this weekend, just to the point of doing the very simple part. There's 2 parts of it. One where you implement brain-dead strategies and run it, and one where you do clever strategies and run it. Clever strategies will require some thinking and some work. The brain-dead strategies are important to get working, just to see that you know how to actually run our simulator, debug if there are any problems in our simulator, and know how to interpret it so you can move on to the second part. So I strongly encourage everyone to write the program that involves the trading strategy, where you buy stocks at the beginning and do nothing ever again, and see what the performance of that is. And write the trading strategy, where you don't buy anything, you do absolutely nothing and just leave it in the bank. Okay? Please, somebody, I encourage you to do that this weekend. Because when you see that, you'll either say, yes, I can run this and I understand what it means. Or you will run it and you say, I have no idea what's happening here. And if so, we need to talk about that. Any questions? If not, let's end it here and have a good weekend. Any questions? Okay, thanks for your attention. I'll see you guys next time. Yes, I gave out back the homework 1's last class. If anybody didn't pick up their homework 1, please go ahead and get it.